Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Transocean stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Transocean is the world's largest offshore drilling contractor. The company leases out its rig, equipment, and crew to drill oil and gas wells. It owns 37 mobile offshore drilling units, consisting of 27 ultra-deep floaters and 10 harsh environment floaters. It is in the process of constructing 2 ultra-deep water drill ships. The company's primary business is to lease out its drilling rigs, related equipment, and work crews. Then it charges customers per day for its services. Currently, Chevron, Shell, BHP, and many other companies are leasing from them. For example, Shell has been leasing one of its ultra-deep water rigs since 2018 with a contract in place that expires in 2028. Shell pays Transocean $473,000 per day for this contract. The company charges from $127,000 per day up to $579,000 per day. A rig is a large machine that is used for drilling deep holes in the earth so that oil or gas can be extracted. There are both onshore and offshore rigs. A rig is almost always an enormous, complex structure that can drill miles into the ground to access oil or gas. These massive structures can be several hundred feet high and weigh 10, 50, or even 100,000 tons. According to a Moody's article that came out this month, the oil industry must spend $542 billion to avoid a supply shock. Currently, oil exploration and production companies are underinvesting into capex after the oil crash last year. Remember when oil prices turned negative at one point? There was no place to store all the oil that was being produced. So instead of an oil company receiving money for its oil, it was paying someone to take it off their hands because supply was so much greater than demand. This likely will not happen again for a long time. The reason demand was so low was because the world was forced to stay home and not go to work or travel or do anything. 2/3 of the oil used is from gasoline we put in our cars. The $542 billion of upstream spending will benefit rig since they operate in the upstream market. Upstream is the exploration and production part of the oil process. Midstream is storage and transportation. Downstream is converting oil and gas into the finished product. When you pump gas at the gas station, you're closest to downstream than any part of the oil process. The company is headquartered in Switzerland and was founded in 1953. It trades on the New York Stock Exchange, Mexican Bolsa, Deutsche Börse, Swiss, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 2.6 billion market cap. They're trading at $4 a share, and they have 651 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do have positive free cash flow each year, except in 2019 it was negative. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative in 18, 19, and 20, positive in the trailing 12 months. Revenue is the sales for the company, and that was growing from 2018 to 2020, then dropped in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue. Ultra deep water floaters was $2 billion, $1.3 billion in the US, $792 million in other countries, $1 billion of harsh environment floaters, $876 million in Norway, $170 million in other countries, and only $12 million of mid-water floaters. Ultra-deep water floaters can drill 30,000 to 40,000 feet into the ocean floor. So you can see how expensive and laborious it is to pull oil from the ocean floor. 80% of their 27 ultra-deep water rigs are under 10 years old. So the fleet is fairly young. They have 10 harsh environment floaters, 5 are for shallow depths, 2 are for deep water, and 3 are for ultra deep water. The company had less than $3 billion of revenue in the trailing 12 months, but as of July 21st of this year, it has a backlog of $7.3 billion of revenue. So there's plenty of demand for its products. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's between $2 and $2.4 billion a year. Below that is their operating expenses, and below that is their operating income, which was negative in 2019, positive in the other years. Here's a breakdown of their 2020 expenses from their 10K. $2 billion is from operating and maintenance, $781 million from depreciation and amortization, $183 million from G&A, and nearly $600 million from impairments. They have lots of assets on their balance sheet, so they're always impairing or writing down the assets. When the value of one of their rigs decreases more than the depreciation, they decrease the value of that asset on the balance sheet and pass through a loss onto the income statement. Here's a breakdown of their operating and maintenance expense. $80 million was from rigs stacked. If they lease out one of their rigs, say for 90 days, once that lease is complete, they need to store the rig. Those rigs are really expensive, so they have to transport the rig and store it in a certain location. That costs a lot of money. That's what rig stacked is, the transportation and storage of rigs until that rig finds another lessor. They paid $75 million in shipyard personnel fees and maintenance, and a bunch of other expenses. And they're always passing through lots of depreciation costs each year, because those rigs are really expensive. In order to reflect the correct value of the rig on its balance sheet, there's a preset depreciation schedule, similar to real estate or a car. Depreciation is meant for normal wear and tear of a fixed asset. Impairment is more like a one-time item. Like if you have a car for your business and say you depreciate it $7,000 every year for 7 years if you bought it for $49,000. But after 2 or 3 years, the car got into an accident. So you might have to impair the value of the car because it's not worth as much money in the open market. So you may have to reduce the value $10,000 or $15,000 in 1 year because of that accident. And here's a breakdown of their G&A expenses. $7 million of expenses from Ocean Rig UDW. They acquired this company back in 2018. $5 million from legal and professional fees, and $5 million from rent. They paid about $500 million of interest on their debt, which was the lowest amount of interest they paid in a while. It was up to $660 million in 2019. So they're doing a good job at reducing the amount of debt they have on their balance sheet. And the bottom line of the income statement is their net income, which is negative every year, except in the trailing 12 months it was positive. The main reason it was positive was due to this $535 million gain in other income and expenses. In prior years they had losses. Sometimes a company can have a loss from an impairment, or they can have a gain from the sale of an asset. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So you can see they do generate a good amount of operating cash flow. The reason they have negative net income every year and positive operating cash flow is because they pass through so many write-downs on their income statement. They have depreciation, amortization, impairments. That tends to happen a lot when you're really asset heavy like this company, when you have a lot of fixed assets in your business. But if you're a tech company like Microsoft or Apple, you don't have as much fixed assets. And they do spend a few $100 million a year on capex. Operating cash flow minus capex gives you your free cash flow. And they do have positive free cash flow every year except 2019. And 2019 was their biggest capex year, so that gave them negative free cash flow. But you can see they're reducing their debt pretty much every year. They reduced it $867 million in the trailing 12 months. $900 million in 2020, and $275 million in 2019. The lower their debt, the lower the interest payments, which means there's more potential money that goes into your pocket, the investor. This is the equity section of the balance sheet. They have $11 billion of equity. They raised $14 billion from selling their business, and they lost $2 billion from running their business. So that doesn't look so great that they have accumulated deficit. but I think it's a timing thing with all the write-downs in the early years. If they do sell some of the rigs, they'll pass through a big gain, or once they depreciate the rigs so much, they won't be able to pass through as much losses. So I think the accumulated deficit will reverse over time. Let's look at the capital structure. $11 billion of equity, $7.5 billion of debt. They're 60% equity, 40% debt. Their net debt is $6.5 billion and their WACC is 10.7%, and that's the WACC on Simply Wall Street. That's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $3.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $3 billion. We divide that by 651 million shares. And we get a calculated stock price of $4.56. They're trading at $4.05, so they're trading at 11% discount. It's a buy according to the model. The average analyst projected their revenue to decrease 1.3%. I decreased their revenue 1.3% from the trailing 12 months to 2021, but I increased it 15% after that. I don't think that 1.3% decrease is forever. I think it's only for a year. And I do think a lot of people are going to start traveling soon, because for a year or two now, people have not traveled. And the people who probably traveled a lot before COVID maybe traveled very little, once or twice during COVID. Once COVID is totally behind us, lots of people are going to go away, visit family, and go on vacations they wanted to go on that they couldn't the past 2 years. So that's why I think their revenue will start to increase a lot after 2021. The way I calculated their future free cash flows, I needed to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers, I divided by these 4 revenue numbers. And that came out to 7%. So I multiplied their future revenue numbers by 7%. That's how I got their future free cash flows. Simply Wall Street is way higher than me. They're at $19 a share. They're saying the stock is 79% undervalued. 4 analysts priced this stock and the average price target was $328. Here's the stock price the last 12 months. When oil crashed in the middle of last year, this stock dropped like a rock. It was under $1. I think around 80 cents at its low point. That would have been a great time to pick it up because the stock peaked at over $5. It is a bit scary buying a stock that goes below $1 that looks like it may file bankruptcy. It was inevitable oil would rebound, and of course it did. It's much higher than it was last year. If the price of oil gets back up to about $100 like it was in the past, this company will make a ton of money because there's always going to be demand for oil. Demand for oil has been increasing about 1% a year for several decades now. That's not a concern. The demand is always going to be there. Now the thing is, how much money does it cost to pull the oil? If it cost a company like BHP $50 a barrel to pull the oil by renting these companies' rigs and renting their crew and all the expenses involved, if oil is above $80 a barrel, it makes sense to lease the equipment from rig. If oil was $20, $30, or $40 a barrel, then why would you rent all the equipment from this company if you're going to lose money every barrel of oil you produce? So when oil gets really low, companies need to find different ways to pull the oil, cheap ways, and it's not that easy. About 1/3 of the oil is pulled below the ocean. A lot of oil is pulled in the desert. Pulling oil below the ocean may be more expensive because it's much more difficult to get access to the oil. When the oil's on land, it's a little cheaper, but it's not always cheaper. It depends exactly where on land it is. The price of Brent crude is the blue line. It pretty much moves in unison with offshore rig utilization. So as the price of oil goes up, this company's rigs are utilized a lot more, but as the price of oil goes down, their rigs are utilized a lot less, which of course makes sense. Oil increased from $41 to $74 a barrel. Utilization is going to increase from 64%, and it's on track to hit 80% this coming January. If oil got to over $100 a barrel, this company's rigs would probably be 100% utilized and they'd be making money hand over fist. Not only would their rigs be utilized, but they could charge a higher rate. The higher the price of oil, the more money they can charge per day. Because say for example they charge $100,000 per day for a certain rig. Say I was Shell, and I used the rig and the crew, and the expenses were $50 to pull a barrel of oil, on average. If oil was selling for $74, it would make sense for me to pay that $100,000. I might even be willing to pay $150,000 per day, depending on how much money it cost me to pull the oil and how much oil prices were. If oil prices got to $200 a barrel, which I know is crazy, but if it did, this company could probably charge $1 million per day for its rigs, and the big oil companies would still make money renting out the rigs because oil prices are so high. This is a really volatile stock. It has a beta of 3.53, so it moves 3.5 times the market. It's gone up 400% in the past 52 weeks, while the S&P is up 32%. The 52-week low was 65 cents, the high was 513, and the stock is trading above its 50-day and 200-day moving average. This is a really popular stock. 18 million shares have been traded on average the past 10 days. Of the 651 million shares outstanding, 602 million are on float, 53% are held by institutions, and over 9% of the shares are shorted, so it has a pretty high short percentage. Their employee count has been coming down a lot. It was around 12,000 in 2015, but the less their rigs are utilized, the lower the price of oil is, the less employees they need. If oil got to over $100 a barrel, I bet their employee count would be over 10,000. During the Great Recession, oil hit an all-time high, and they were generating over $12 billion of revenue per quarter. So for several years, they were bringing in tons of revenue. But the last 5-6 years, with the low oil prices and low utilization rates, their revenue has come down a ton. It's a really cyclical industry. They had a few really solid years, but the past 5 years have been a real struggle for this company. There is a decent chance revenue comes back to these levels again. If it does, your stock may 10 or 20x. The past few months, there's not much insider selling, but there is a lot of buying. Frederick Mohn, a director, is buying lots of this company's stock. So that is a bullish sign when insiders are buying. If you invested $10,000 in this company 10 years ago, you'd be down to $1,000 today. That's a 90% loss. So you can see the past few years, this stock has really struggled. So you have to really time it right when you invest in a commodity-linked company. So this might be the right time to invest. Vanguard is the biggest shareholder at 8.38%, then PrimeCap. Then one of the directors owns 7%, Van Eck and D.E. Shaw. Let's look at their financial ratios. Their PE is close to the market median, 22. That's stock price over earnings per share. They have a really good price to sales ratio of 1.0. That means their revenue equals their market cap. And they have an amazing price to book of 0.2. This indicates if the company sold all its assets today, used that cash to pay off all its debt, it would have enough money left over to pay each shareholder $17.37. That's how valuable the assets are on its balance sheet. Those rigs are worth a lot of money. So they can just sell all the rigs and make you a 4x return. Of course, you don't invest in companies so they sell all their assets. You invest in companies so they sell a product or service and make revenues and profits from that. They have a really low return on invested capital of only 0.2%. They can only cover 10% of their interest payments with their operating income. Operating income is on the income statement. And remember, the income statement items are artificially low because of all the non-cash items that are on the income statement from this company. So just take that into account when looking at these numbers. They have a really low ROE at 1%. They have a high current ratio and quick ratio, so they can easily cover their current liabilities with their current assets. They have about $1 billion of cash on their balance sheet, $500 million of receivables, $400 million of inventory, and $500 million of restricted cash. They do seem to be well capitalized. They have $400 million of free cash flow in the trailing 12 months, $1.3 billion of working capital, so they have $1.7 billion of funding. So to summarize, I have them trading at 11% discount. But remember, my model is looking at their prior financial information and using some estimates for the future. Their prior 4 years of financial information included really low oil prices. If oil breaks $100 or even gets up to $150, this stock can easily 10x. So I definitely think it's worth the risk because the stock price is so low at this point. There's so much upside potential. There's always downside potential, but it's pretty limited when you invest in a stock that's only $4 a share. If I can scrounge up some extra cash, I may throw it into this stock. I rank their free cash flow 6 out of 10, their revenue 5 out of 10, and their ratio 6 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.